Hi, I'm Mark King, Head of EMEA Investment Content at Columbia Threadneedle Investments. Joining me today is Mark Burgess, Deputy Global Chief Investment Officer and Chief Investment Officer EMEA, and we're going to discuss some of the key themes driving markets. These include equity market performance, the corporate earnings outlook, China, and fixed income market signals. Mark, we saw something of a choppy end to 2018 and a little bit of a rally so far this year. What's going on in equity markets?
Well, 2018 really quite an extraordinary year, because if you remember, during the first half of the year we were talking about maybe an overheating US economy, fiscal stimulus, tax cuts, unemployment trending down towards 4%, and maybe that additional stimulus to the US economy being inflationary and forcing the Fed to raise interest rates more aggressively than we'd previously expected. Sure enough, the Fed responded to that, started making some relatively cautious statements about the outlook for rates. Bond yields rose and equity markets sold off. Very quickly, however, on the back of a number of factors, trade wars and so on and so forth, markets started to worry about growth not being enough, actually. So we went from growth being too much to growth not being sufficient, and we had downward revisions to growth forecasts globally, and markets sold off very aggressively. So we found ourselves at the end of 2018 with markets having sold off, valuations looking more attractive, and we've had a rally to reflect that, because interest rates aren't going to be raised aggressively. Clearly the Fed has said that. Corporate profits continue to grow, market valuations look more attractive, and we've had a rally to reflect that.
Yeah. You mentioned the Fed being very dovish there on rates. Is that your outlook for the whole of 2019?
Well, clearly we are analysing the data with a fine-tooth comb to make sure that we see no signs of inflation. And despite that fiscal stimulus, which is obviously now running off, and despite unemployment continue to fall, coming through 4%, there are almost no signs of inflation in the US economy. And whilst the inflation remains very benign, there is no reason for the Federal Reserve to raise interest rates aggressively. So I think that's actually quite supportive for markets, both equities and credit. Valuations, as I've said, look okay. Corporate profits growth is coming through, and clearly interest rates don't feel like they're going to go up in a big way anytime soon. And that's quite a benign backdrop for markets, which is why we've seen the rally that we've seen.
Talking about corporate earnings, what's your outlook for various regions around the world? Is it fairly robust for this year?
Well, we started earnings season on a global basis, and corporate profits are generally coming through, and we're thinking sort of 5 to 8% depending on the region. Some regions will grow more quickly than others, but I think on a global basis, earnings growth of 5 to 8% is probably likely.
Moving across to China now, where economic growth has clearly been slowing, are you concerned about any impacts on emerging market and global growth there?
So China in the crosshairs of Trump's trade policies, clearly looking to rectify the large imbalance that they have with China, a large current account deficit, and tariffs imposed on a number of goods and services that have looked to rectify that balance. That's actually slowed Chinese growth really quite materially, and we've seen, as you say, a downward revision to Chinese growth and a downward revision to growth in the region more broadly. Now, we've also had a dollar headwind, which has been an issue for the region, and we think that will reverse to some extent. The region looks to be much better placed in terms of fiscal and current account deficits, and so we think that the Chinese growth will moderate, but the region in the round will be able to accommodate that growth slowdown and still looks like a relatively attractive place to have risk assets deployed.
Finally, Mark, what are your thoughts on where we are in the cycle, how close we might be to recession? Are the fixed income markets giving us any indication?
I don't think they are signalling that. I think they're signalling low inflation, which we've already discussed. Clearly, credit markets will remain supported by relatively robust corporate profits. The global financial crisis was 2008. We're into 2019, so 11 years from the last downturn. So by definition, we're closer to the end of this cycle than we are the beginning. But I don't think a recession is anywhere now in the near term. Maybe in the next 2 to 3 years we'll have a recession, and maybe it'll be okay. I don't think we need to be anchored by the fact that the last recession was a calamitous event. I think if we had 2 quarters of negative growth and nothing more significant than that, then I think the global economy could withstand that. Certainly the financial system's in a more robust position. Corporates are in a better position. Governments are relatively indebted, but outside of governments, I think debt's relatively manageable. So I don't think we're anywhere near a recession at the moment, but if we did have one, it wouldn't necessarily be a disaster.
Could be a gentle slowdown rather than a cliff edge.
Yeah.
Mark, thanks very much.